Hey, good evening, guys. Ken at Tortoise Capital Foundation's Q&A check-in for October 19th, 2023. Um, let's do a quick check-in, see how guys are feeling. Greg, what's going on?
Doing well, Ken. Happy to be here.
Me too. Jonathan, how are you?
Doing fine. I think I'm making good progress with the course, and all's well.
Well, the histogram will be the judge of that, and
You will.
and your accountability partner and your significant other.
Not in that order. Yes.
Yeah, exactly. Sean, how are you doing?
I'm doing well. I'm loving the course. There's so much information and I feel a little scattered, is why I asked the instrument question.
Well, I
Um,
noticed that you'd signed up for the Kata 2 challenge. That is one way to decide what to trade, and that is to start with a couple symbols that are representative of a large class of targets, and then just trade those two with just the patterns that they're going to teach you, and then do first things first. Master those patterns, which are robust in every time frame, and master those patterns on the targets that have been given, which represent a broad conservative index, the DIA, and a aggressive volatile non-US index, which is Brazil. And I'm not sure if they're trading CLF, the US steel company, as a representative of the individual stocks that are kind of surprising. So that's one way to decide how to trade, but that's really a continuation question. That's a question that should like always be on your mind, you know, for a particular time frame. So as I'm sitting with my trading plan prepared every day, and the market's getting ready to open, how do I decide what to trade right from the open? So the way I answer that is slightly different than the way I answer, well, what do I decide to trade at the 30-minute mark of the day and at the 2 hours and 30-minute mark of the day? And what do I trade through lunch? And what do I trade coming out of lunch? What am I trading going into the close? What am I going to hold overnight? What am I going to hold for a week? And what am I going to hold in my long-term buy and hold portfolio with the trailing stop? The thing that ties all of those together is deciding what candidates to trade. And so there's a skill and time of day and time of trade, personal objectives, risk tolerance, calendar timing, trade life cycle timing. All of those go into a factor of deciding what to trade. How are they behaving relative to each other? So there is a relative strength, comparative set of questions to ask. That if I've chosen 10 ETFs that represent 10 parts of the world market model, what are their conditions and which ones do I want to trade of that group? How does the answer to the question that I'm asking compare to all the other things that I currently holding? So what's already open and the position is in play, so that is a top level question that your trading strategy should consider. And the end result of that is a set of targets that are well prepared Like you come out of in the plan, prepare, execute, and assess, PPEA, you come out of the plan with the answer to the question, which targets are worth preparing? So there's a filter that goes in there. Like I can only prepare so many. So how many different contingencies do I want to be prepared for? So I've already answered that question to a certain extent. I put a constraint on it, said, how many can I actually prepare for the decision that I got to make? And how long am I going to hold them? So, this entire course and our dialogue every night is really trying to answer exactly the question you asked, which is the first part of the which ones do I decide to trade? And then how do I allocate risk capital among the ones that I've chosen to trade? And then I'll ask you to define, when you say, which ones do I decide to trade? Are you asking me which ones come out of my plan? Are you asking me which ones I consider at the start of the plan and then which ones come out of the plan? Or are you asking me, of the ones that I have prepared, how do I choose from among those in a given moment? Which is a slightly different question, because you answer that one on the basis of, is the market open and how much information do I have and what is the current market sector and target condition, which shapes an answer to that question. It includes a self-assessment that says, how am I thinking and feeling emotionally and cognitively, and what are my skills, and which ones can I take on professionally? And what is the purpose of the trading that I'm about to perform? Is it an exploration of a new idea that I want to examine quickly for feelings? Or is it part of a production level decision that I've got to make to achieve financial objectives? So now we could add the purpose of that. So what I might suggest is that after we get done here is that you listen to that little section again and then start drawing a mind map of all the questions that I just asked and the considerations, and have them pointing at the central idea of how do I decide to act? What other variables do I consider? And then you might say, I might say, compare that to the diagram of your current process that says, well, how do you? And then you tell me what's working and what's not working. Put a letter grade on those parts of your trading process. Then compare that to the process diagram that I've put on the homepage and say, what's in my process that's not in your process? What's on your process that is not on my process? What is common to both of those processes? Now, having asked those three questions, where does that lead me in answering my question? What do I think about the results of that analysis? Then I might ask, what is the purpose of the question? Is it to help you refine things that are going pretty well, but you want to get better? Or is it to fill a gap that doesn't feel comfortable at all? Like, it has recently come to my attention that one of the things I got to do is decide what to trade. So maybe I need to think more about that. So a lot of that is kind of, where are you in your investigation phase? So I don't want to answer that question too briefly or too specifically yet. Because I'm treating this course where we are here as kind of a graduate seminar in which, students and the co-teachers and learners that come in already have a vast amount of experience already. And as like a doctoral supervisor or a master's thesis supervisor, a lot of what I do early in the career of the research is to just map out what your cognitive map looks like. What do I know? What do I feel? Where have I been? What are the results? What are the gaps? What's got your attention? What is making you curious? What is making you hungry? What are you emotional about in your own trading that you're responding to? What's the gap that you're sensing that we're trying to fill in? So it really requires some investigation on your part to help us refine the research question. But that's really an important question: is how do I decide what to do? I'm gonna say that if you start with the 2 short videos that are on the tortoisecapital.net page, it says, how do I prepare for the trading day ahead? That's a walk through the main process that I follow every single day that informs core trading, swing trading, and day trading. So that's about the most comprehensive answer that I could give to you. And that's going to be the diagram, by the way, that let's see if my little drawing pen here will work. That would be nice. There it is. I was trying to find the annotation bar. So it's the diagram which basically says, if this is where the market closed, and I've been actively engaging in trading as price is monkeying around, and it comes into the close and I've stopped trading the equities, and this is where that market is going to open the next morning, there is 16.5 hours from the moment that it closes to the moment that it opens. And at the opening, I've got to be ready to trade. And then how do I fill in the gap? How do I get from here to here? I defined first, what do I mean ready to trade? Well, what are the how do I know if I'm ready to trade? Well, I've got targets and they are prepared and I have rehearsed and my infrastructure is set and I'm in a zero state and I've scanned the information from the futures market that tells me how this is going to open compared to how it closed. In other words, what is the gap information available? So all of these things here that I just mentioned are preconditions to be ready to trade. And it includes a set of, like I said, prepared targets. And the answer to the gap question starts directing me early from among the targets that I've prepared, which are the 2 or 3 that I'm going to emphasize from the open to the first 30 minutes. From a list of about 30 symbols that are on my stack, which are sorted by percent change from the close, high to low, I'm going to take a look at the ones that have the biggest gap down and the ones that have the largest gap up, and I'm going to take 2 to 3 trades out of that bundle and trade them on 3-minute charts on the basis of which ones have moved the most. Because everything that I've put on my target list are things that are in compound critical states and which are prepared to make larger than normal moves today, and any one of them could be the one that moves the most. And by examining the size of the gap, the ones that have moved the most the first are the ones that I'm going to pay the most attention to. Who's running through the streets with their hair on fire, screaming wildly? That's the one that's in an emotional state. That's going to be the one that's in play, and that's going to be the one that I concentrate on until I get a better idea. And in the first 30 minutes, that's all I'm going to do in terms of discretionary trading. At the 30-minute mark, I'm going to shift my attention to 30-minute charts and scan everything that's on the list, looking for, on each one of those charts, spending 2 to 4 seconds, seeing if anything is in play or interesting or exciting. And so if I spent 4 seconds times 30 charts in 2 minutes, I can complete that scan. And from that, I'm going to make decisions on what to trade from plus 30 minutes to 2 hours and 30 minutes in 30-minute segments. So the answer to your question, or my answer to your question of how do I decide what to trade, is fundamentally connected to how I intend to trade. The style and the targets and the patterns and the time frames. And then the answer to your question for me is really a recipe or a process model. So it's not just which ones get on from the plan, which become targets that should be prepared, and it assumes that I have prepared them correctly, but now it takes current information to start making decisions about how to select the very few, because in the first 30 minutes, my maximum span of control is 4 different symbols at once with 4 units of risk. And if I have one symbol and I put 4 units of risk on it, then that's my span of control right there, because I got no more capital left, and I'm managing all of my capital on a single symbol, which is the maximum that I can do without losing my mind. Or I could have 2 symbols with 2 units of risk on it, 2 bullets, or I could have 3 symbols with 1 unit of risk on each one, and then 1 in the ready rack, ready to reinforce the first one that moves the most, or add a 4th position with that last bullet. But I usually like to keep, if I've got 3, I like to keep one bullet in reserve to add a 2nd position. Like if this is the 1, I can add the 2nd position here and then look to cut the other 2, so that I can scale the one that really is working. That's what I'm trying to do to answer your question in the first 30 minutes. Let me furthermore answer that question by looking at how I answered Sundeep Gupta's question about how to get back on board with the symbols, and this was as close of an approximation to how I'm trading right now with the hybrid swing as I can put into words. I said, well, use the sniper trade of the day on 3 minutes to get started on some symbols, by which I mean 2 to 4 symbols, in the first 30 minutes. I just said that. Check or hold. Then, let me open this up a little bit to make it easier to read. Once again, trying to find my annotation bar. I know it's in here. It's hiding on me. Ah, there we go. So in the first 30 minutes, what I just said. Then after 30 minutes, shift after 30 minutes to include scans and surveys of the other symbols in my stack that are on the hybrid swing portfolio listing. Those are the ones that you see me managing in the Nightly Strategy podcast, in the opening of that nightly podcast. So there's about 30 symbols in there. And at any given time, 20 of them have an open position on, which is my maximum span of control for the hybrid swing. Because again, of those 30 charts, I can evaluate it, each one of them, in 4 seconds, which means in 2 minutes, I can cycle through all 30 of those symbols. So when the market, or when the candle closes at 30 minutes in, the next time I get, and the bar is open and whatever, and it's moving around, the next time that bar closes is at 60 minutes. So I have 30 minutes from the time this bar closes that this is the live bar. And in the 30 minutes that it takes to do that, I can scan every one of those things in 2 minutes. So theoretically, I could do 10 cycles of 30-minute decision making every 30 minutes. I don't go through it 10 times because I already know that if this thing is looking like this and I got an entry here and my stop loss is here and the next place that I could add a position is here, and I just watch this thing monkeying around in here, I can put an alert here and here, and I don't even have to look at it. It takes me 5 seconds to put an alert to be able to come to that particular trade frame inside of my stack. If I get an alert, then I can go, that one gave me an alert. Let me call that chart open and see what's going on. But if I had to, and I will, go through all 30 of them, it takes me 2 minutes to do that. That is part of the answer to the question, how do I decide what to trade? Part of it is, what is my process model for making that selection? How did it get on this list? What am I prepared to trade it with? So at the 30-minute mark, I am managing those things that are on 3-minute bars, plus the other 27 symbols that I'm just looking at on 30-minute bars, and I'm doing that routinely during the day. And I'm managing that before adding this, cutting that, and so forth. Adjusting the alerts and adjusting the stops using visual chart trading. And then I simply do that all day, refining the sniper trade of the day, the one that I'm trying to concentrate on the 3-minute chart, as things shape up during the day, which is just the English language version for managing the markets and all my stops and monitoring reward to risks and making decisions along the way. At lunch, when volatility slows down, I make sure that I do a special midday review for things that start moving out of the lunchtime compression. Here's my theory, that after the open, that first 2.5 hours, you get a lot of volatility and a lot of the moves of the day have occurred. And then somewhere in the middle 90 minutes of the day, you get volatility compressing and things start getting into the chop. My theory is that in the afternoon, when things start moving again, I can detect some of that movement early by looking to see what is moving more during the quiet period of the lunch, so that when it comes out of lunch, I'm already tuned into the things that are already moving. And it may be that I had a large move, a quiet continuation, and another large move in the afternoon. Then I have an entire day of engagement with what becomes the sniper trade of the day, which started off as a 3-minute bar in the first 30 minutes. So I'm using lunch and my analysis at lunchtime to help answer your question, how do I decide what to trade? In the last hour of the day, I'm making decisions on what to close and what to keep overnight from the list of 30-minute symbols. You know, which small handful of those am I going to keep overnight, and which ones am I going to keep overnight? It's either one that is very, very, very interesting, which is an inside joke, or it's got markets money in hand plus interesting, meaning that it's early in its 10-day trade cycle. Like this could be something that was day one of a swing trade, and this was the day that it looks like it really started moving. So everybody that sees that tonight falls in love with the chart that I'm already in, and they're going to put in large orders at the open, and I might get a favorable gap. That's what makes it interesting. Now, what gives me protection is that I've already got market money as a buffer to protect me against an adverse gap. If I don't have markets money, one time in 100, you might see me hold something that not only was just interesting, but is very, very, very interesting. Meaning I can't help myself. So that's what I mean by making the final call 30 minutes out on what I'm going to hold overnight. As I'm doing that review, I'm also thinking about tomorrow's trade as if it was going to open in 5 minutes, and I'm going to start framing trades for tomorrow for follow-throughs on the basis of where today's high and low and support and resistance were. So I'm already before this market even closes, as I'm getting into the last 90 minutes, I'm studying this to decide what is interesting for follow-throughs for tomorrow. And then that's going to take 16.5 hours before the open even occurs. But I'm already making some decisions today about what I want to prepare for tomorrow and where the support and resistance levels are. So I know I'm already starting to build my plan for tomorrow today as a result of the after action review or the analysis I'm doing. Now, in this last 90 minutes, I'm also going to do some work on any forex pairs that I have been trading during the day, because any forex trade that I'm working here doesn't stop right here. It's going to continue to monkey around over here. So I may be trading forex during the time that I am preparing ETFs. So there's only a couple forex pairs that I trade, but I might trade them, and that's part of the answer to the question of how do I decide what to trade. I only trade a little bit of forex, And I trade them all the time on the basis of support and resistance. So what I told Sandeep was, number 9, establish and map and document your daily trading practice in terms of times and tasks. That's what I've done on those 2 videos for you. One of them talks about how I do plan and prep to go from the close to the next day's open. And the second one talks about how I divide that market day into 30-minute segments, and then what I'm concentrating on throughout each of those 30-minute segments, and then what I'm doing at the open and what I'm doing at the close. Once you see those 2 processes, it is a very small leap to understanding what I do for swing trading, which is trivially easy compared to what I'm doing to day trading. But the good news is it's the same targets, it's the same patterns, but it just adds the swing trade signal generators and market conditions that you see me talk about on the weekend report. Then I told Sandeep, establish a 1-page checklist of process control reminders for you to ensure that you're doing what you say you will do, including rest, food, stretching, meditation, so that you can sustain yourself while you're doing all of this work that is directly connected to trading. You've got to have other human support processes that allow you to endure this trading plan that you're putting together. And then if you find yourself trading pieces or parts of the things that I trade, well then you might compare your work to my nightly strategy podcast debrief to check on your performance and insights against my performance and insights and those of the other traders, so that you can find out what are the things that you want to sustain and what are the things that you want to improve when it comes to planning, preparing, executing, and assessing. So you think about what you did each day for planning. What was good that you want to continue? What did you abstain from that was a good thing? I resisted the urge to go beyond the limits of my expertise. Hey, that's a good thing. Keep doing that. And what are the parts of planning that I want to improve on? So that gives you a list of possible things to improve tomorrow. And there are some specific actions, maybe maximum of 2 to 3 a day, that of all the things that you want to sustain and improve, you want to highlight 2 or 3 things to make sure that you do tomorrow with focus to improve on with accountability. And then I'm going to ask you, how are you going to make sure that the things that you commit to in your daily after action review, you actually do, and you score yourself with accountability to see how you're doing? And then I told him longer term, when he's ready, take foundations, creativity, and a new coaching program I think I'm going to do called Work in Progress, where he can check in and follow up on doing all of these things and use that for his accountability. So that's what, in foundations, you're here to learn the broad outlines and then focus on a few particular systems that'll get you well started on our path. The COTA 2 Challenge course that I saw you sign up for is going to give you detailed lockstep process instructions with students that are on exactly the same lesson, with exactly the same checklist, with a skilled production coach, and checking your homework and really locking in the COTA 2 Challenge, which is the use of the supported spring crossing, the collapsing dragon, and the COTA 2 on EWZ and DIA for a 6-week period, so that you master those 3 essential patterns, which are central to understanding how we trade on every time frame. And it turns out that if you trade those on 3-minute to 10-minute charts, you'll get enough repetitions that you will become a master of those patterns, and you'll gain a lot of experience about what it is like to trade a conservative, low volatility liquid ETF like DIA, the Dow Jones 30, big fat large caps in the US, and you'll find out what it's like to trade a big fat index, Brazil, that has a wide range of business sectors, but it is driven by political, economic, currency, and regional considerations that make it less correlated to the S&P. So if the S&P is the market that we're using to guide us, DIA is really strongly correlated to that by a factor of 0.95 correlation coefficient, but it is less volatile. So that's good. It's a great big fat slow cow that will feed us. And then EWZ is correlated to the S&P by about 0.6. So you get much more volatility, and sometimes it'll go up when the S&P is going down. And so that now gives you the ability to trade things that are similar to the S&P and somewhat divergent to the S&P to see if you can start managing two targets in your span of control. Once you find out what your skill levels are on those, you can start answering your own question even more about how to decide what to trade, because now you have some actionable information about patterns, symbols, personal skill, a structured process that you can then do process improvement on. And now you'll realize that the answer to your question is an open-ended process where we're trying to use continuous improvement to get better all the time. So that is the longer version of the answer to your question. The longest version is the Foundations course, which is about, and all the Q&As, which is about 1,000 hours of absolute mind-numbing drudgery. It's like 20 miles of bad road. I've answered that one as much as I intend to for tonight, with your permission.
Thanks, Ken.
Yeah, it's the first thing that moves out of the hybrid frog box, Greg. From the open, what is the first thing that moves a hybrid frog box from its open? And I'm on that. Out of all the things that are, now here's what I expect. That of the 30 things that are on my prepared list, and the ones that gapped up the most, and the ones that gapped down the most, those are the ones that I think are most likely to move fast and big. So from the open, if I put a hybrid frog box or an MMRB bracket on each one of those, from the open, every single one of those 30 things, every single one of them, the first one that moves out to the downside is the first thing that I'm going to short. And the first thing that moves out to the upside is the first thing I'm going to go long until I get 3. And then I've done what I'm supposed to do in the first 30 minutes. I think that the most likely source of those 3 are going to be the ones that gapped the most, because they have the most energy. But it's not impossible that something had 0 gap and also was the first thing to move. First three to move, they get my money, and off they go. My priority is kind of like, hey, is it a bear market? I want these. Is it a bull volatile market? I hope it's one of those. If it's any of these, I'm ready to go, because that's a surprise. So how do you create that? That's part of your prep process. Automate your system so that from the open, plus or minus your MMRB, you get an alert. That's trivially easy for a professional trader. If that's not trivially easy, then you have a high priority task for mastering your trading infrastructure, because that is an edge. It's only an edge because you identified 30 things to study. Hey, maybe you only want to do 5 things. Okay. How many can you, that's a span of control issue. How many can you set up and react to? Maybe it's 5. In the Kata 2 challenge, you don't do that at all because you only have 2 charts open, and that's EWZ and DIA, and you can just watch them. And what you can do is draw the 2 hybrid frog or MMRB boxes to the correct size, which you know as soon as the market closes, you know how big that box is going to be tomorrow. And then you got 16.5 hours to draw those 4 boxes on your 2 charts to set yourself up for tomorrow. And I don't go to sleep until those boxes are drawn on all the charts that I have ready for tomorrow. Like, I don't want to get up in the morning and then try to draw boxes and be ready, because I like to sleep until 5 minutes before the market opens so that I am well rested. Because if I spend more than 5 minutes looking at the futures, I'll start monkeying around with it, and then I get distracted. I want to wake up and be ready to trade the open within 5 minutes of waking up. Because that's like being in the army in combat again and being woken up from a sound sleep and being told to run the brigade command post as the units are reacting to contact with lives at stake. And that's when I'm at my best, because I don't go to sleep until I'm well prepared. And if I'm not well prepared, then I don't go to sleep. That's the habits of 40 years. So I was anticipating the pain and suffering that it was going to take to answer your question as soon as I saw it in the chat, which is why I was holding my head in pain. Not because it hurts me, because I love the sound of my own voice, but because of the pain I was about to inflict. Jonathan asked, on the weekly report, given the quality of the ETF2 system, which is considerable, it is a conservative weekly asset allocation model that was built for a hedge fund that was very, very conservative. And over the last 25 years, we've had 4 significant emotional events in which the market collapsed and lost more than 50% losses and absolutely destroyed people's retirements 4 times. The internet bubble, long-term capital management, financial crisis, and real estate bomb. Every one of those 4 events in the last 25 years have caused the S&P to lose more than 50% in a short period of time, and it blew up. Each one of them absolutely blew up long-term buy and hold, diversification, efficient market hypothesis, which is basically a load of bullshit. No, it's not. It works 98% of the time. Yeah, but in the 2% of the time that it doesn't work, that fat tail event happened 4 times in 20 years, in 25 years, which means every 6 to 7 years, which is how long it takes to really forget what it was like to be in that, or to raise a new generation of young, naive children with discretionary money, or guys that made a fortune in their business and think it just translates into success in the market. It takes about 6 or 7 years to raise a whole new pile of dumb money in order to get smashed in a new fat tail event. So the ETF2 system is a weekly asset allocation model that is very conservative, that incorporates timing and a market model which governs a risk in the market for the week ahead. So it makes a decision each week about what percent exposure is justified by the condition of 10 large ETFs, which, if you map them to the world market model and you said this was the US and this was the globals, you would say, well, the top 6 is emerging markets, the Euro-Asia blend, Asia less Japan, small caps, the European 350, and Latin America. That's a pretty good representative sample of half of the world's equity, because that represents about 50% of all the money that's in equities globally. So there are 6 ETFs that govern that. And then there are 4 ETFs, the S&P large caps, the NASDAQ, the Russell mid caps, and then the Russell small caps. There's about 40% of the world's market money in that in the US. So I just call it even and say it's 50-50. And then what I use is a timing model, which says that the 4-month moving average has been a very good barometer of when to be bullish and when to be cautious with respect to the next 5 days looking forward. And why do I pick 5 days? Because our statistical analysis of the market says that the worst 5-day segments in all of those indexes were responsible for about 1/2 of the percent lost during all 4 of those market meltdowns. Like if it lost more than 50%, half of that, or 25% of it, was lost within a 5-day period. So if you're not prepared by that fact, then you might just drift along and readjust your portfolio once a month. But I know that that is a fact, and so I make a decision every week about how much risk to have for the week ahead. And then what I do is that I take each of those 10 ETFs and I make it responsible for about 10% of the asset allocation model and compare it to the 4-month moving average filter. Right now, all 10 of them are below the 4-month moving average. So that means the ETF2 model, which is very conservative, and which in all 4 of those market explosions, the single worst drawdown in any one of them was in the first one, in the internet bubble, and its worst moment was down 8% when the S&P was down 50%. The other 3 market models, or the market meltdowns, we were never negative, and we were making money on the way down. So we actually got better once we understood how to trade that. So this model, the ETF2 model, has certain rules that govern how to trade ETFs with weekly relative strength rebalancing. That set of rules is complicated. It's too hard to teach you when there are other better ways to swing trade. And if we're talking about holding things for a week at a time, all the ETF2 model does is it's a swing trade that works on a weekly chart. Well, there are now much better ways to swing trade. But what was magic about that system was the asset allocation model, which protected us against all four of those massive market meltdowns. That little model right there is responsible for saving hundreds of millions of dollars in the retirement accounts that are managed by professional managers who are following the insights of that model. So Jonathan asks a very good question. How does it affect the percent invested in my position systems? Well, my blended monthly rebalancing model, which is a monthly rebalancing, picks three things and holds them for 1 month. And it has a 10% trailing, it has a 10% trailing stop on each one of those. And then if that thing ever hits the trailing stop, then that position goes to cash for the rest of the month. And then it rebalances every month. And what I do is I compare the monthly asset allocation rules of blended monthly rebalancing, which says the following thing. Depending on how many of the symbols are in your portfolio of interest, like I show an ETF 13, a 22, and a 32, and then there are some other ones. But what it does is it picks the top three. It picks the top three members of each portfolio, and it seeks to hold in those three positions 1/3 of the entire portfolio, unless that thing is below its moving average filter, in which case that position goes to cash. So that is a form of the ETF2 model that is used to help with the asset allocation and blended monthly rebalancing. So the specific answer to your question is, if I'm using the BMR as written, the ETF2 asset allocation rule that talks about when a position should be in cash versus when it should be open is used directly to determine after each monthly allocation if those three candidates are ownable for the month ahead. And that thing starts with a view of the week ahead. Now, once I own the position, I trust the 10% trailing stop. I don't use that asset allocation model to exit that because I have a 10% trailing stop. And since that's only 20% of my money, I'm not going to monkey around with that. I let those rules just work. It's a very wide stop, unless in that month it earned 15%, in which case I move the trailing stop to 5% to take advantage of the outsized gains that I earned in a single month, because it turns out that a 15% move in any 1 month in these big fat ETFs is a really extraordinary gain and should be preserved. So the last question was, do I have statistics on what percent of the time the system's at 0%? It really has to do with, I'm going to say less than 30% of the time it's at 0%. I used to track that carefully. It just became tedious. It's relatively easy to do. You can actually go to ETF replay and you can test weekly ETF portfolios, market conditions, BMR versions that adjust weekly, monthly, and quarterly to your heart's content for about $20 a month. And you will discover that that the basic strategy of BMR and ETF2 should give you anywhere from 2 to 3 times the market return at anywhere from a third to 1/2 of the market's volatility over long periods of time. Enough on that. The daily report, I'm distributing only the first 10 or 15 pages. Will I do I'm thinking about it. What I discovered was the extra pages were causing a lot of people to play Trivial Pursuit instead of just doing the right thing. So I might be persuaded to make a separate report for a select group of subscribers at a different price point and just make it available to professionals. I'm thinking about doing that, but I got to get the book and the new workshop done first. I'm still thinking about that idea. It was a recent thing where I trimmed the daily report down to just the essential pieces. So I want to sit with that decision for a little bit further. But the answer would be, yeah, you can get access to it, and at some point I will soon. Regarding the swing systems, what's the open positions the same way I day trade to less than 4? For me, it's 20 overnight is the absolute max. I feel comfortable with 5 out of 20 because I have about a quarter loaded. It makes me feel good that if I had 2 long positions and 2 short positions, each of which were in the money, the chances that all 4 of those hit their maximum trailing stop in the overnight gap is a non-zero number, but it's a small number. And then I can add the position back on. That makes me feel pretty good. But I would say, as long as you're, what matters is your portfolio heat first, and then track that to the number of open positions. And then that will tell you how much position size you can afford. Like if you said, hey, I want to have 10 positions, each with a 10% trailing stop, then your portfolio heat would be 10%, and those 10 are probably manageable. But that's kind of how I would do it. I feel comfortable between 10 and 20% overnight portfolio heat. That's what I would say. In my asset allocation model, where I have position, swing, and day trading, the day trading portfolio has about 40% of my money. The swing has about 40%, and this has about 20%. But this has 0 overnight risk. And with leverage, I can quickly intraday put a hedge on to make this market neutral instantly. Because I always know what my net position and direction is. I always know the size of the intraday futures play that I got to make to get this thing to net market neutral. Close enough for jazz. Because I'm trading things that are always very strongly correlated to the S&P. Then I can use a single hedge to buy the portfolio protection with day trading money as a hedge to protect against that. If there's some reason that I'm not going to be available the next day, or if I had some reason to believe that the swing and core portfolio were especially at risk, like, oh, we just went into a bearish volatile market, I could actually use pieces of the swing portfolio to market hedge that at the close, so that I go into the close market neutral and just pay the price. And if I was that worried about it, that's probably when I'm trading the overnight market with the futures, because this is going to be so damn volatile that it favors professional trading. That's what gets my attention. That's the only thing that makes me want to trade at night, is I got to protect something and it's very volatile. Oh, I'm sorry. If I know if you know my swing systems are outperforming the day trading systems, which is like the hybrid swing, but you decide to keep day trading only the day trading symbols, the question would be why? Well, it's to get repetitions to understand the patterns fast, or other reasons. But at least it's so I can master the trading patterns quickly. Then something less than logical could be going on. So it might be a deliberate, intentional experiment to rapidly learn with skin in the game. Now, that's not irrational. That is actually very, very logical. Like, if you want to earn a black belt in judo or jujitsu fast, you go into the dojo and you go up to each black belt in turn. I throw you, you throw me, bow, and move to the next black belt. You fight black belts as many times as you can, all day, every day. And you learn from them. That's what you do. So a decision to get lots of reps is logical. But there may be, as you point out, maybe there's some excitement and ego and fear to contend with. That sounds like a belief. And what we do with beliefs is note it, and then we start looking for evidence and facts and truth with a research partner and accountability, and find out, well, you asked your own question. Well, which one? And I'll ask you, well, which one is it? And why do you believe that is true? Well, that's for you to answer. But now you have my permission to start studying the answer. To what extent are these things part of the little 12-year-old inside of you, the monkey mind that's affecting the big rational adult? So what do we do with the excitement generated by this guy? We want to reward it. And then we want to channel that energy into useful activity. We want to encourage that energy. And then we want to focus it, because the hardest thing in the world to do is generate energy for the drudgery of going to work and trading the markets every day in the way that we trade them. We're going to go, hey, what are we going to do today, Dad? We're going to go down to the brickyard and we're going to make some bricks. Awesome. That's my idea of fun. Really? Well, so don't neglect those things. Reframe that to say judgment neutral, value neutral, or make that negative feeling into a positive feeling to say, how do I get more of that? How do I make it safe as well as interesting and exciting? Reframe. What's the breakdown of swing trades that were put on initially as swings, and then swing trades that evolved out of day trades? 4-1 started off as a swing trade that became a turbo intraday trade. And while it's open, so while this is happening, as long as I can turbo trade that each day and the swing trade is open, then the other way to ask that question is, of the things that you're day trading, how many of them also have a core swing trade as part of the package? 60 to 70% of the day trades also are the turbo portion of a core swing trade. Most of the things that I'm day trading already have a swing trade on it. And I'm just participating because I'm already paying attention to the swing trade. Since I'm already there, I just do the prep, and now it makes it very easy and efficient to maintain that. The only time that's not true is if it's one of the old reliables, like EWW, EWZ, EEM, TLT, Cliff, Devon, etc. And these things all gap so much that it's just better not to suffer the gap and better just to start the market fresh at the open. It opened here. I put the damn box on it and say, which way is it going to go? And I also want to know how big was the gap down or up? And the bigger the gap, the more likely I want to trade it. So when I look at my stack of 30 things, if one of the old reliables is one of the top gappers or the worst gappers, then I know what I'm trading today. To get back to the earlier question about how to decide what to trade. Wait, no, that was not Jonathan's questions. That was, maybe it was Lou or Joe. No, that was Joe's question, sorry. Jonathan, however, did ask, when I'm evaluating the overall condition of something, of a target, it looks like I might use any of the indicators as well as price levels for support and resistance. Do I have a protocol or hierarchy for which ones that I look at? Yes. The most important support and resistance levels are the high and low of the day, each and every day, because that is the primary boundary of yesterday's range. And that is the first time that I know that that thing is likely to be a swing trade, is the mechanical entry long and the mechanical entry short. So those are, by definition, support and resistance. And it's the first thing that I track. And this is part of the protocol that creates the auto framer. Because most of the time, that range risk is what generates the risk portion of the reward to risk ratio, and it uses from the mechanical opening to the 10-day high, and that's where the reward to risk comes from. So that is the most important thing. Check or hold. Then, by far, the RL10 turning points. And I'm going to draw that as a blue to represent the RL10. As you know, that thing, I should have drawn that correctly, and that is, it always comes to a point because of math. Anything that breaks north of that is an emerging dragon in the same way that the high and low of the day represented, the yellow zone breakout. The peak of the RL10 in both directions also acts as a critical price level. And not only is that a thing that if it breaks through there, I should have been able in this region to get one position long from somewhere for some reason, and that thing should be going north. And if it breaks above here, I should have enough markets money in here so that I can use markets money to fund the next position long. And the same thing down here. So the RL10 turning point is not only a key indicator for a break of resistance, it also acts as a price target so that if price opened here and then sold off and then started to go, maybe with a couple cotta twos, and I can get some kind of MMRB down here, and I can get this entry. This also acts as some kind of reasonable price target to the upside to help me get the reward to risk ratio computation. So when it's resistance, that means it helps me estimate a reasonable upward move where if it starts failing, I'm not surprised because it failed there the last time. And if it finds support here, I'm not surprised because it held there the last time. The next thing is the bigger, fatter, slower moving dragon. It always turns after the RL10 does, and it never gets, so it happens after the RL10, and it never gets as far down as the RL10 did. So if I was going to just draw those two things, I would say, you know, your RL10 peaks are there. Your dragon turns are a little smoother, and they occur later in time. So even if you don't act on that, you could use that as information to act on this. Like the SSC acts as soon as it crosses the SSC acts as soon as it crosses the dragon, now you're long. But the owl entry waits for the dragon and the RL30 to change. So sometimes you want to act sooner, sometimes you want to act later. Part of your trading plan is to describe how you might use those two things to help you time those key turning points, because if you can get those two things right, about 1/6 of the total price action from peak to peak can be found in this noise and in that noise. And it leaves about 2/3 of the channel for you to capture the move. And if you could just get half of that move in the middle, now what you're doing is saying, hey, if I could get the middle third of a move, I could be 33% efficient on a size of a total move. Chuck LeBeau and Van say, man, you can make a very good living just by getting the middle third of a big fat move. I'm trying to get a little bit more of that. Like by reducing this to a 1/6 and a 1/6, that gives me up to 2/3 to get. I'll settle for a third, but I'm really aiming for 2/3. So how soon after it turns can I get in? How soon after it turns do I get out? That's how much I'm giving up and how much I'm giving back. And that's what I'm trying to get in the middle. And most of the time, there's going to be a cotta two where I ended up giving back something in the middle. And that's why I can't get that perfectly every time, because sometimes this grinds up with a kata 2. But sometimes in a collapsing dragon, that first move is massive and it never stops. It just fails huge, which is why I prefer that. The next things that I would look at is the turning points of the dang PSAR. Imagine that was a series of dots, and imagine that was a series of dots. That little PSAR flip box establishes absolutely crucial support and resistance levels. It's so important that we designed the RL10 to be the price feeder for the PSAR. So when the PSAR flips, it mathematically is flipping at a point where the peak of the RL10 was. So it actually reinforces the idea that where the RL turns is hugely important. Now, in between the turning points of the RL10 is the middle of the river, the SMA 30, which is the absolute middle of that thing, which is the reversion to the mean trade. And that gives you two legs. So from turning point to turning point, leg one, pause, leg two. What is it going to do after an extreme move and it reverts to the mean? What is it going to do in here? Well, most of the time, it's going to chew you up in the crocodile river. So you got to be able to capture the move and capture the move and stay out of the damn river. That's why it's hard to get the middle 2/3. That's why your goal should only be the middle third, because you're going to inevitably lose some money inside here. It just is going to happen because of life and crocodiles. If you can't manage the crocodiles, then you are part of the herd that's going to eventually get eaten. So you want to be thankful that the river is filled with crocodiles that eat the unwary. So don't be the unwary. Be the sprinter that gets in fast, crosses fast, and gets out fast. If it's not fast, then you should get out. Don't mess around in here. It's red because of all the blood. So, as in terms of support and resistance, that Bollinger Band mean and the river. Now, in the RLFF strategy, key support and resistance occurs at the RL270 and where the RL10 reversed. That distance, this identifies resistance and that represents support. So if you can turn that into ATR boxes or MMRBs, you can now calibrate that distance, and then these two extremes become turning points. And the same thing to a lesser extent with the RL90. So where those two indexes turn matters. Now, since the rest of the world studies the 200 period, 50 period, and 20 period simple moving averages for their stupid moving average systems, then you must pay attention to those. But remember that the herd is studying those, and you're studying the herd. So you better know what the herd does at those levels. I add back range stats, gap stats, and Fibonacci retracements because those are just units of measure for size of moves that could become, statistically speaking, support and resistance in a non-obvious way. So you asked me what my indicators are to help me frame trades when I'm using the support and resistance lens. It's these and that priority with the reasons that I just explained. And that leads us into the close for today. And I need to take a 2-minute break so we can reset for the daily trade. Hamad, I've got your list of questions, but it's an hour answer for all of those, and I will provide those on Saturday. And I will add that to the foundation's check-in. Okay. Thanks a lot for the good questions and hopefully the answers were helpful. 3 good sections in there, broadly speaking. Thanks a lot, guys, and we will see you shortly.
Thank you. Appreciate it.